G'day traders, Rich here. Today I thought I would have a look at a couple of walkthroughs that demonstrate the power of compounding. I think what long-term success in the trading industry is dependent on is the identification of trading strategies that have a small edge. And when that edge is applied over a very long time frame, the real ultimate success of your wealth building exercise is determined by the compounding effect. So we have stressed in our prior podcasts how the success in this game over the long term is based on simple but highly diversified systems that can survive a broad range of market conditions. Now, survivability in this game is so important because without survivability, you can't take effect of the compounding effect on your return stream. So, a key prerequisite to be able to achieve long-term wealth building returns in this game is firstly survivability. So to be able to survive in a broad range of different market conditions, you need very simple strategies that are not curve fit for a particular market condition, but are generic in nature and can be applied across a broad range of market conditions. So trend following itself is one of those very simple philosophies that are applicable across a broad range of market conditions. The basic principle is this: either markets trend or they don't. If they don't trend, you don't want to have active trading during those particular conditions. But when they do trend, you want to be particularly active in trading those trends. Now, our systems themselves are the devices in which we navigate those market conditions. They don't dictate terms to the market, but rather the market dictates terms to those systems. So if our expectations in trend following is applied to a single market, you need to realise that it is only when that market is trending that your strategy will perform. At other periods of time, it's either going to be stagnating or experiencing drawdowns. Now, in terms of survivability, the better systems are those that don't achieve excessive drawdowns during non-trending periods. This is from a trend following perspective. So how we overcome this is we diversify in our trend following solutions across a broad range of conditions that allow us to squeeze the juice out of trends when they occur. When trends are absent in the market, we only at worst might have one system operating. But when trends are active, we've got a range of different systems operating that squeeze the juice out of the potential trajectories that those trends may take. Now, most traders, when they develop trend following systems, they only develop a single system applied to a particular trending condition. And the system itself has design constraints such as its stop loss, its trailing stop, or its method of entry or exit that basically can whipsaw it out of a trend even though the trend continues on. Now, these design constraints that are built into a system means that if you trade a single system, you are preferring a single form of trajectory that a trend will take. Now, trends come in many different shapes and flavours. So by diversifying your suite of trend following systems, you are therefore allowing for a range of different possible trajectories in the future that trend may take. By doing that, what you're doing is you are reducing your overall whipsaw effect, and you are increasing the efficiency of your risk-weighted returns or risk-adjusted returns via your diversified solution of strategies. So that's enough of the broad theory. So what I thought we'd do is we'd conduct a walkthrough Now, the first walkthrough we're going to do is a walkthrough where we apply a 0.5% trade risk to every trade we take. So 0.5% of our equity at that point in time is allocated to a particular trade. So as time goes on and our equity builds, you can see that when you apply a trade risk percentage, your trade risk in relation to your equity stays constant at that relative relationship. This is different to, say, a fixed dollar risk, which we use for testing our systems, which is more just to define whether an edge is present in a system. But in the reality of live trading, we'd be applying a percent trade risk. Now, the reason we do that is because with these systems we generate that offer positive expectancy, over the very long term, that trade risk percentage is essential because it applies the power of compounding to your return streams. So this particular walkthroughs will show two results. One over a short-term 20-year period for the Euro USD, and one over a 50-year period. Now, the reason we're doing this, using the same suite of systems, is to demonstrate how the power of compounding significantly increases your overall wealth building returns over the long term. So when we are demonstrating this system, you need to think in terms of, this is not a cash flow generating exercise, this is a wealth building exercise. So this is something that you apply over your lifetime, say 50 years of trading. Because over that, you are effectively using these systems which you have developed that are robust, have a small edge, but you are looking at the impact of compounding those returns over the long term. So this type of strategy is very suitable for things such as superannuation funds and pension plans, where when you're in your 20s or 30s, you invest in these programs, and then when you are 60 or 70, you retire, and all of the hard work has been done through the power of compounding using this very small edge. So let's get started, and we'll just now use the Euro USD using our Donchian breakout system, but we are using a diversified suite of values with that. You'll see that in action as we go through the walkthrough. The date range we're using is from 2000 up to the current day, so that's the 5th of March 2020. We're going to be using double the spread, so the current spread is 12 points. We're going to be using 24 points for this exercise to incorporate a degree of slippage into our assumptions. And now we're going to run the test. So I'll just slow things down a bit. And I'll now, that's perfect. Okay, so we can see the equity curve below. The blue line is the realised balance and the green line is the floating equity. These style of strategies do not warehouse risk. So at the end of each trade event, we exit our trade and fully release the risk embedded in that trade. That we prefer that to systems that have negative skew. So this system has positive skew. What we mean by positive skew is that we have many small losses with whipsaws, but very large wins when we get onto those trends. When we have negative skew, that's the reverse. We have many small wins, but the occasional large losses. Now, with negative skewed systems, that green floating equity line lies below the realised balance, and it can get extreme. So when market conditions change, you suddenly find you have a string of large consecutive losses, and you meet risk of ruin head on. That's why we prefer positive skewed systems, because when we go into unfavourable conditions, we might get many losses, but they are small in nature. Therefore, our drawdown is not a rapid descent, it's a slow decline, like we're experiencing now over this period from 2014. But now you see we're now entering a strong trending period. We've got a large number of shorts from this Donchian trader, and our equity has now flown up. So that's very large wins with very many small losses. But you can see the overall shape of the trajectory, and you can see that with the percent trade risk, our volume in trade size is progressively slowly getting higher and higher and higher. That's because our equity is building, and as we're applying 0.5% trade risk, our trade size is therefore relatively adjusting to accommodate that increased equity. So we're getting a very nice result with this very simple trend-following system over a 20-year period. And now we've just reached current day, and that's where it stands. So I'll blow up that equity curve. And so we can see that, yes, we do get periods of stagnation, such as here, and periods of slow building drawdowns. We don't get rapid drawdowns or rapid descent in drawdowns because our systems are very robust. But when we do get the trending conditions, such as in 2014, you get this marvellous uplift. Now, just to demonstrate that, we're going to go back to 2014 on this screen here and see what was happening. So I'm just going to go back. So when we are in general non-trending conditions, so this is effectively a sideways moving market, you'll find that if we do get any trade activity here, we might only have one solution trading this, which is the shorter term Donchian look back, and we might only have one solution. Or we might have no solutions because our solutions are dependent on trending conditions. So therefore, during these unfavourable market regimes, we are not exposed with our trade activity during those market regimes. However, when markets start trending, we find we have multiple solutions triggering and capturing these trending conditions. So during this short phase, we had, in this instance, 5 solutions triggering at different points with different trailing stop mechanisms to take advantage of different trend trajectories. So we didn't know at this point here what type of trajectory we would get for this trend. So we need a broad range of solutions here to define a range of different possible trajectories. Now this is the same as a lot of traders saying they add to winning trades. What we do is we configure our strategies so that when we are in trending conditions, we might get multiple strategies firing and trading. So we are taking advantage of that trending condition. And during that particular 2014 period, that was responsible for this rise in equity from around 221,000 up to 321,000. So over that short period, we generated almost a 50% return on our equity just through that 2014 period. When we now go to the statistics of this overall report, we see that we've got a very good profit factor of 2.05. We started with an initial balance of 100,000 and we made $179,854 in profit through this solution, and we took 306 trades. Average profit trade was $3,349 and our average loss trade was $854. So this demonstrates that positive skewed nature of this strategy. Our average winners are much bigger than our average losers. Also, in terms of our our trade win percentage, we had a relatively low trade win percentage. Short positions won 40% or 41%, long positions won 27%. So you can see that we're well below the 50% trade win, but what we are, our principle of trend following is looking at the edge that arises from the average win to the average loss ratio. So it's not the probability of a win that is important to us. It is the extent of our winners, how much we make on those winners, and what is our average losses. If our average winners are far greater than our average losses, we can afford to have a winning percentage of less than 50% and still generate very heavy profits. So that now that therefore demonstrates a 20-year backtest. Now, we haven't actually seen clearly the impact of of compounding. So what I'm actually going to do is I'm going to save the reports here so we can compare them at the end. So what I'll do is I'll take a snapshot of this result, and I'm just going to use that to compare against this next walkthrough, which is now going to be going back to 1971. So with the Euro USD, the currency itself became active in 1999, but there were the basket of the euro currencies has been active since 1970, so you can actually calculate the Euro USD exchange rate back to 1971. So a lot of brokers' data actually can provide a lot of data back to those early periods before the actual Euro USD was implemented as a currency. So we're going to be using that data, but in that early data we only have one price per day. So fortunately our strategies only operate off the open bar condition, so they still work when we only have one price per day. So it is not dependent on open, high, low, close, our particular strategies, but all it is dependent on is an open price. So therefore we can undertake these very long-term back tests with fairly rudimentary data. So we're now going to go back to 1971 and we're going to run it. So I'm going to slow this down a bit. So here we go. These dots here, or these charts, represent this single price per day. We immediately start entering. Now back in the 70s through to the 2000s, trend following was supreme. We had very good market moves in trends, and the industry accept this fact. But since 2000 on to current day, the trend following landscape has become a lot more competitive, plus the nature of markets have become a lot more mean reverting in nature. So trend following was exceptionally successful back in the earlier days of between 1970 through to 2000 by virtue of the characteristics of the market itself and by virtue of the fact that interest rates were far higher, which allowed trend followers, which maintain a lot of their position in cash, to get very good rates from just holding cash with the interest rates. But subsequent to 2000 we lost the benefit of the interest rates on our cash holdings, and also markets became much more competitive. We got things such as high frequency trading coming in after GFC in significant numbers, and during that period we had many more market participants trading these markets speculatively. So the impact of that increase in mix of participants have made the markets more tough to crack in regards to trend following, but it still works, and this will demonstrate it anyway. But we're now up to 1977. You can clearly see our strategy has been performing beautifully and our equity is soaring. As we go down to see our trade volume per trade, you can see that we're slowly starting to pick up, but there is still not enough history here to demonstrate the power of compounding. So we'll let it run first a bit far forward. So I'll speed things up a bit until we can get to some bars we can actually recognise. So when we get to the around about the 1990s, you start seeing the open, high, low, close coming into our trade data. Things are going well. Very nice short here. So our equity is significantly building during this trending period. We're now up to about 2.8 million in equity, starting from a $100,000 start. You can see that our trade sizes are now significantly increasing from what they were originally. That is this percent trade risk calculation used that's coming into effect. So our lot sizing is getting bigger. Equity is still rising. So now we're up to 1984. So let's have a look at some of these. So you can see that we're having some very nice long trades as we're going through here. Our equity is really quickly increasing. This is a combination of both the fact that we are in trending market conditions and it's the impact of this progressive effect of compounding taking over. So this compounding is based on this weak edge that's present in this system, and over longer term time frames, that power of compounding really starts to influence your equity curve. You can start seeing now we are at maximum lock conditions for MetaTrader, so we are the number of lots, we're getting close to the maximum number of lots. So when we get to 100 lots, unfortunately our brokers won't allow us to take larger positions than that. So at that point in time we effectively go to a fixed lot arrangement of 100 lots per trade. Equity is building and building. We're now up to 1993, so we've now got our open, high, low, close. You can see that the Euro USD is officially commenced at this point in time. We're now in a drawdown period here. This is 1994. But now, towards the end of the 1990s, we get some very nice favourable trends coming in, especially long trends as the euro is rising. Here's a short phase here. So the key thing about when trading this style of system is, one, you must have a very long-term perspective. This is a generational perspective, a 50-year perspective, a pension plan perspective, or a superannuation perspective. It is not something to look at from the perspective of immediate cash flow generations. That doesn't occur with these trend following solutions. What this is all about is wealth building returns. So this is where your children are given a pot of money, you implement some diversified trend following systems with them, and you let it sit there in their trust until their retirement age. And a bit like the Forrest Gump story with Apple, where he didn't even know what he was buying, but 30 years later he realised he was sitting on a fortune. This is what happens with this style of system. You can see our equity is absolutely taking off. At this point here we're at 2004. So you've got to think this is just one market, Euro USD. We haven't even diversified across multi-markets here, so this is just to demonstrate the power of this. But it's one market with diversified trend following systems being applied. So this is perfectly tradable in its own right without having to have a diversified portfolio across different market sectors. But of course we go much broader than this. We go across market sectors, across asset classes, because what that does is we get an even better overall risk-adjusted return on our equity curve, because at different points in time we get different trending conditions for different market sectors. So if you can imagine compiling collections of these together that have different drawdown profiles, different trending periods, when you blend them together you get these magnificent soaring long-term wealth building equity curves. So we're up to 2010 here. Look at this marvellous growth in the equity curve. So soon we're going to go to that really good short phase during 2014, which is a great outlier in Euro USD. Now we can see the power of compounding take effect with our lot sizing. Look at the gradual increase in our lot sizing, and now we are maxed out at our maximum lot sizing here. So compounding can't take effect from this point on, but it has certainly been slowly present during here. But the impact on this to our overall equity is significant, and we'll see that soon when we compare that 20-year results against the 50-year result. Here we are during that magnificent short phase. Look at the lift in that equity curve at that point in time. So I'll speed things up and get to the end of this exercise. You've probably had enough. (2018). Alright, so we're finished. So this is a 50-year back test on Euro USD, and it's quite clear that this system has positive expectancy, but the edge in it is actually weak. But what is actually taking hold of this equity curve is this power of compounding. So let's now compare and contrast the results of this. I'll have to wait till the results generate. It still takes some time. Here we go. So there are the results of our runs. So let's compare and contrast that with the 20-year backtest we took earlier. Let's bring that over now. So our 20-year results is above, and our 50-year results is below. So we start with 100,000 in both instances. Our total net profit for our 20-year result was 179,854. Our total net profit on our 50-year results, now this is because of compounding, was $38 million. $38 million. You can see that the profit factor, 2.85, hasn't changed significantly, 2.32. You can see that, of course, our average profit trade and our average loss trade has significantly altered from the prior 20-year backtest because of this impact of compounding. You can see that our relative drawdown in our original 20-year test was 24%, but in our entire 50-year test is only 24% again, 23.76. So the system's the same. What the difference in the results are from is simply the power of compounding. I hope this really strikes home how important it is to find systems that have a weak edge. Now, for the retail trader, they typically find it very difficult to find systems with an edge over, say, 3 years. That's because they're looking for unrealistic returns, or they're looking for returns based on a single market condition that might be significant during the times those market conditions persist. But because markets adapt over time, and because markets throw at you a broad range of different market conditions, if you want to take effect of the compounding effect on your monies, it is essential that the first thing you choose are robust systems that can survive a broad range of market conditions. If you can't get past that 5-year period or 3 to 5 year period with the testing of your strategy, that demonstrates that your strategy has got a finite shelf life. That signifies that your strategy has either been curve fit for a particular market condition, or it is simply random luck that you have succeeded over 5 years. However, the chances of random luck occurring as you go to 30 years, 40 years, 50 years, that evaporates. What you have then is the signature of systems that have a weak edge and are robust and can survive a broad range of market conditions. If you can achieve that with your systems, which means you need very simple systems that are robust, if you can achieve that, then it's actually the power of compounding that generates your wealth building returns. Not your system. Your system just needs to be robust, simple and diversified. And in this case, because we're catching trends, you need the market to demonstrate that trends persist. Now, that's not going to change anytime soon. For price to get from point A up to a higher or lower price, it must trend. But it might take a broad range of different trajectories. That's why diversification of your systems is so important. You don't want to select one particular trajectory, as every time a trend occurs, a trajectory might be different. You want a diverse array of different trajectories with your trend following models. So guys, that's it for this particular episode. I hope you enjoyed it, and stay tuned for more. Thanks very much. Bye.